Right now, as you are watching this, the total household debt in America has hit $18.8 trillion. That is a number so massive that our human brains struggle to even process it. But here is a number you can process: $104,000. That is the average personal debt for a single American adult in 2026. Whether you are 30 years old and just starting your career, or 75 and looking at your retirement accounts, that number is a weight around your neck. But here is the strange part. We are working harder than ever. The labor market is tight. Many of you received raises over the last 12 months. So why does your bank account still feel like a leaky bucket? Why does it feel like there's an invisible ceiling on your wealth that you just cannot break through? It is because of 5 silent habits. These aren't mistakes you make once. They are patterns you repeat every day because they feel normal in today's economy. Like habit number 4, a convenience habit that research shows is costing the average American family over $4,000 a year in hidden markups and service fees. We are told inflation is finally stabilizing at 2.7%. That sounds like good news on the news, but have you looked at your grocery bill lately? Have you seen your car insurance premium or your utility costs? The official numbers say one thing, but your wallet says another. Think of your wealth like a ladder. You're climbing, you're putting in the hours, but these 5 habits are like someone greasing the rungs of that ladder. You're moving your legs, you're exhausted, but you aren't going up. You're just stuck. My name is Chris, and this is Chris Finance. Today, we're not talking about buying too many lattes. That's old advice for a different decade. In 2026, the game has changed. Today, I'm exposing the 5 silent money habits that are keeping you stuck without you even realizing it. In the next 20 minutes, I am going to give you a literal blueprint to reclaim at least $500 to $1,000 of your monthly cash flow. No gimmicks, just the cold, hard truth about why you are stuck and exactly how to get unstuck. Let's start with the one that is haunting your bank account while you sleep.
Habit number 1, the subscription ghost. Let's dive into the first silent killer of your wealth, the subscription ghost. Back in the 90s and the early 2000s, the American economy was built on ownership. If you wanted a movie, you bought a DVD. If you wanted software, you bought a box with a disc. You paid once and you owned it forever. But in 2026, the economy has shifted into what experts call the rental economy. You own almost nothing. Everything is a monthly line item. Right now, the average American spends $91 a month on streaming services alone. But that is just the tip of the iceberg. When you add in gym memberships you don't attend, cloud storage fees, premium shopping delivery services, and those pro versions of apps on your phone, that number jumps significantly. According to recent 2026 consumer data, the average household is leaking over $200 a month, not a year, a month, on digital services they haven't even touched in over 90 days. I call this the subscription ghost because it is a phantom. It doesn't show up as a big, scary bill that makes you catch your breath. It shows up as $9.99, $14.99, or $24.99. It haunts your bank statement at 2 a.m. while you're asleep, quietly siphoning off the top of your hard-earned paycheck before you even wake up to spend it. Think of it like leaving every faucet in your house dripping. If you saw a massive flood in your living room, you would call a plumber immediately. But a drip is easy to ignore. The problem is, a drip over 10 years is enough to rot the foundation of your entire house. For my viewers in your 30s and 40s, these ghosts are eating your ability to invest and take advantage of compound interest. For my viewers in your 60s and 70s, these are fixed costs eating into your retirement distributions during a time when every dollar of purchasing power matters. Here is the 2026 reality check. Companies have become absolute masters at frictionless spending. They make it one click to sign up, but they make it a 10-step maze to cancel. They're betting on your decision fatigue. They know you're tired after a long day of work, and they're banking on the fact that you won't spend 20 minutes on the phone or navigating a website just to save $15. But let's look at the wealth gap this creates. If you find and kill just $80 a month in ghost subscriptions and move that money into a high-yield savings account or a low-cost index fund, you aren't just saving $80. Over 15 years at a standard market return, that ghost money turns into nearly $30,000. That's the difference between a ghost and a legacy. So here's your first action step. It's called the digital audit. This weekend, I want you to pull up your last 3 months of bank and credit card statements. Don't use a third-party app if you don't want to. Just use your eyes. Look for the recurring charges. If you see a charge for something you haven't used to improve your life, your health, or your actual happiness in the last 30 days, kill it immediately. You aren't losing a service. You're buying back your financial peace of mind. Remember, in 2026, wealth isn't just about what you earn. It's about what you stop losing to companies that are hoping you stay asleep.
Habit number 2, lifestyle creep, the I deserve it trap. Now, let's move to a habit that is perhaps the most dangerous of all because it feels like a reward. Lifestyle creep, or what I call the I deserve it trap. This habit is the primary reason why in 2026, over 50% of American households earning over $150,000 a year are still living paycheck to paycheck. Think about that for a second. You can earn a top-tier salary and still be broke. How? Because as your income goes up, your lifestyle expands to swallow every new dollar. For my viewers in your 30s and 40s, this usually looks like the upgrade cycle. You get a promotion or a 5% raise. Suddenly, that perfectly functional car you've been driving for 4 years starts to feel old. You think, I'm a manager now, I should drive something that reflects that. Or maybe it's moving from a perfectly good apartment to a larger house you don't actually need, simply because you can now afford the monthly payment. But for my viewers in your 60s and 70s, lifestyle creep looks a bit different. It is often hidden in convenience spending or luxury travel that exceeds your safe withdrawal rate. You've worked 40 years and you feel like you deserve the best of everything. And you do, but not at the cost of outliving your money. Here is the psychological trick your brain plays on you in the age of social media. We compare our insides to everyone else's outsides. You see your neighbor with a new electric truck or a freshly renovated kitchen, and you feel behind. But in 2026, that neighbor is likely part of the record $18 trillion debt statistic we talked about in the beginning. They aren't wealthy, they are just highly leveraged. They don't own that lifestyle, the bank does. Let's look at the wealth gap math. Imagine you get a raise today that gives you an extra $500 a month in take-home pay. Option A is the lifestyle creep path. You upgrade your life. You get a higher car payment, a more expensive gym membership, and you eat out twice as much. Your bank account balance at the end of the month stays exactly the same as it was before the raise. You are still one emergency away from disaster. Option B is the wealth path. You keep your lifestyle exactly where it was. You take that $500 and you automate it into a basic S&P 500 index fund, like VOO. If you do that for 25 years, that extra $500 turns into nearly $600,000. Ask yourself, is that new car smell today worth more than $500,000 in your pocket later? The habit keeping you stuck isn't enjoying your life. It is the habit of letting your expenses creep upward alongside your income. If you want to break the ceiling, you have to maintain the gap. The gap is the distance between what you earn and what you spend. Wealth is not found in the paycheck, it is found in the gap. In 2026, the most radical thing you can do for your future is to live like you are still making your 2022 salary while earning your 2026 income. That is how you build a fortress around your family. If you can master your subscriptions and stop the lifestyle creep, you have plugged the biggest leaks. But next, we have to talk about the anchor. Habit number 3 is the one that physically prevents you from moving forward, no matter how much you try to save.
Habit number 3, the high interest minimum. If the first 2 habits were leaks in your boat, habit number 3 is the heavy iron anchor dragging at the bottom of the lake. It is the habit of paying the high interest minimum. In early 2026, credit card interest rates in America are hovering between 21 and 28%. That is historically high. Yet the average American is carrying over $6,500 in credit card debt. The habit that keeps people stuck isn't just the spending, it's the psychological trap of seeing that minimum payment due on your statement and thinking, okay, I can handle that. Let's look at the math, because the math is where the truth lives. If you have that average balance of $6,500 at a 24% interest rate and you only pay the minimum each month, it will take you over 20 years to pay it off. By the time you are done, you will have paid over $8,000 in interest alone. You will have paid for that original $6,000 balance twice over, and you still won't be debt-free until the year 2046. For my viewers in your 30s and 40s, this is a wealth killer. You are literally handing your future compounding power to a bank so they can build a bigger skyscraper. For my viewers in your 60s and 70s, carrying high-interest debt into retirement is like trying to run a marathon with a backpack full of bricks. It limits your choices and creates a level of stress that you simply do not need at this stage of life. The bank loves your minimum payment. In fact, they are your favorite customer. They don't want you to pay it all off. They want you to stay exactly where you are, just comfortable enough to keep paying that interest month after month, year after year. To break this habit, you have to stop looking at your debt as a monthly bill and start looking at it as an emergency. In the field of finance, we talk about the debt avalanche versus the debt snowball. The avalanche focuses on the math. You pay off the highest interest rate first to save the most money. The snowball focuses on the psychology. You pay off the smallest balance first to get a quick win and build momentum. Both work, but neither works if you are still stuck in the habit of just getting by with the minimum. In 2026, with the cost of living where it is, you cannot afford to give 24% of your money away to a billion-dollar lender. Every dollar you pay in interest is a dollar that isn't working for you. Break the habit of minimum thinking. Look at your highest interest card today. Even adding an extra $50 or $100 above the minimum can shave years off your debt and save you thousands in interest. Don't be the bank's favorite customer, be your own favorite customer. Once you cut the anchor of high-interest debt, you'll start to feel the boat move faster. But there is another habit, habit number 4, that is draining your account through convenience, and this one is costing the average family over $4,000 a year without them even realizing it. Habit number 4, the convenience tax. Now we've reached the habit that is perhaps the most invisible because it's marketed to us as saving time. It is habit number 4, the convenience tax. In 2026, we live in an on-demand world. If you want food, you tap an app. If you want a package, it's at your door in 2 hours. If you want to buy something but don't have the cash, you use buy now, pay later services like Klarna or Affirm. But here is the secret the industry doesn't want you to calculate. Convenience is a product, and you are buying it at a massive markup. Research shows that the average American family is now spending over $4,000 a year just on the convenience tax. For my viewers in your 30s and 40s, this is often the delivery app trap.
When you order a $20 meal through a delivery service, by the time you add the service fee, the delivery fee, the small order surcharge, and the tip, that $20 meal is now $35. You just paid a 75% tax for the convenience of not driving 5 minutes to pick it up yourself. But for my viewers in your 60s and 70s, the convenience tax shows up differently. It shows up in your insurance policies and your banking. Many of you have been with the same auto or home insurance provider for 15 or 20 years. You stay because it's convenient and you don't want the hassle of switching. However, in 2026, insurance premiums have skyrocketed. By not spending 30 minutes to shop around or call an independent agent, you are likely paying a loyalty tax of $500 to $1,000 a year more than you should be. The same goes for your bank. If your money is sitting in a traditional big bank savings account earning 0.01% interest, while high-yield savings accounts at places like Ally or Marcus are paying over 4%, you are paying a convenience tax of thousands of dollars in lost interest every single year. Think of convenience like a luxury car. It's nice to have, but you shouldn't be driving it every single day if you're trying to build wealth. In 2026, the convenience tax is the premium you pay for being too busy to manage your own money. The companies know you're tired. They know you're stressed. They are betting that you'll trade your future financial freedom for 10 minutes of ease today. To break this habit, you need to reintroduce friction into your life. Delete the delivery apps from your phone for 2 weeks. Force yourself to drive to the store. Call your insurance agent and ask for a requote. Move your stagnant cash into a high-yield account. When you stop paying the convenience tax, you aren't just saving money, you are taking back control of your time and your labor. You worked hard for that money. Don't give it away just because a company made it easy for you to do so. We've plugged the leaks, cut the anchor, and stopped the convenience drain. But there is one final habit, habit number 5, that is the most psychological of them all. It's the habit of waiting for the right time. And in 2026, it is the number one reason why people stay stuck forever.
Habit number 5, the wait-and-see trap. We live in a world of constant noise. Every time you turn on the news or scroll through your feed, you are hit with a new reason to be afraid. The market is too high, a recession is coming, interest rates are about to shift, or wait until after the next election. For my viewers in your 30s and 40s, the wait-and-see trap looks like sitting on the sidelines with your cash because you're waiting for a market crash so you can buy in at the bottom. But here is the 2026 reality. While you were waiting for the perfect time, inflation at 2.7% was quietly eating 3 cents out of every dollar you own. In 3 years, that's nearly 10% of your purchasing power, gone forever. For my viewers in your 60s and 70s, this habit shows up as analysis paralysis. You're worried about protecting what you have, so you keep your money in a standard checking account or a low-yield CD because it feels safe. But safe in 2026 is actually a guaranteed loss of value if your returns aren't beating the rising cost of healthcare, energy, and groceries. The wait-and-see habit is based on the myth that there's a perfect time to build wealth. I'm here to tell you there is no perfect time. There is only time in the market. Think about the biggest names in the field, like Warren Buffett, were the experts at Vanguard. They don't try to time the exact bottom of a cycle. They understand that the cost of waiting is almost always higher than the risk of starting. If you had invested $1,000 in the S&P 500 10 years ago and just left it alone through all the wars, the inflation, and the political chaos, you would have more than tripled your money today. But if you waited for the news to be good, you would still be standing at the starting line, watching everyone else finish the race.
In 2026, the biggest risk isn't the market going down 10% next month. The biggest risk is you doing nothing for the next 10 years. To break this habit, you have to stop being a speculator and start being an investor. An investor doesn't wait for the weather to be perfect. They plant the seeds because they know the season will eventually change. Whether it is opening that Roth IRA, finally starting your 401k contribution, or moving your stagnant cash into a diversified portfolio, do it today. Even if it is just $50. The habit of doing is what creates wealth. The habit of waiting only creates regret. We have covered the 5 habits keeping you stuck. You now see the invisible ceiling. But knowing about the ceiling isn't enough. You have to break through it.
We have spent the last 20 minutes identifying the 5 silent habits that have been greasing the rungs of your financial ladder. From the subscription ghosts haunting your bank account to the wait-and-see trap keeping you on the sidelines, you now see the invisible ceiling for exactly what it is. But here is the truth. Knowing where the leaks are doesn't fix the boat. You have to pick up the tools and start plugging them. As we look at the rest of 2026, the economic gap in America is widening. On one side, you have people who are letting these habits dictate their future. People who will wake up 5 years from now with the same bank balance and more debt. On the other side, you have the action takers. These are the people who decide today that good enough is no longer enough. If you're in your 30s or 40s, your greatest asset isn't your salary, it's your time. By killing these habits now, you're literally buying back decades of your life. If you're in your 60s, 70s, or 80s, your goal is protection and peace. By removing the convenience tax and the high interest anchor, you ensure that your legacy belongs to your family, not a credit card company. Here's your 2026 blueprint. First, perform that digital audit this weekend. Second, commit to the gap. Live on your 2022 income and invest the difference. Third, stop being the bank's favorite customer. Kill that high-interest debt with everything you've got. And finally, stop waiting for the perfect economic news. It isn't coming. The only perfect time to build wealth was 10 years ago. The second best time is right now. I told you at the start that breaking these habits could reclaim $500 to $1,000 of your monthly cash flow. For many of you, it's actually much more. That money is yours. You earned it. Stop letting it slip through your fingers. My name is Chris, and my mission here at Chris Finance is to make sure you have the tools to win. If this video opened your eyes to a habit you didn't realize you had, do me a favor, hit that like button. It tells the algorithm that this message is important for other Americans to hear. And I want to hear from you. Down in the comments, tell me, which of these 5 habits has been your biggest money leak? Is it the subscriptions? The convenience tax? Let's start a conversation and hold each other accountable. If you haven't already, subscribe to Chris Finance and hit the notification bell. We have a lot more deep dives coming up to help you navigate this 2026 economy. Remember, being stuck is a choice made of small habits. Being free is a choice made of small changes. Make the right choice today. I'll see you in the next video.